Let's get to David George for his take on the regional bank results. David, what's I guess some of the key threads you would pull out of the numbers so far this quarter? The market seems to be not really worrying about any adverse surprises, but also not that enthusiastic.
Yeah, and good afternoon. I would say, from my perspective, Mike, the takeaway from these results is really stability. And what I mean by that is revenues across the board have been pretty stable. Expenses have been relatively well managed, and credit quality, for all the concerns out there about CRE and the consumer, credit quality continues to be in good shape. And while the group has pulled back, keep in mind over the last 6 to 8 weeks, the banks are up a good 30 to 35%. So I think some profit taking is not surprising. And if we get a couple more days like this, I think it's time to start getting a little more aggressive on the long side on some of these regional banks here.
You've characterized credit quality as normalizing, I guess, for the most part for these institutions, but not necessarily getting to worrisome levels. We did see the Discover Financial get hit today on some of the delinquencies going up. Obviously, the company has some other issues as well. Then again, if I look at a Capital One or some other consumer proxies, they're well above their lows from late last year. So where do we think about, how do we think about credit right here?
Well, we really try and think about credit, Mike, through a normalized lens. And banks, as you both know, are cyclical in nature, and the most cyclical part of the income statement is the provision. So it's important when times are really, really good or really, really bad from a credit perspective is to think about what's normal and value the stocks accordingly. So in thinking about that concept, consumer credit loss is relatively normal. Again, with a 3.7% unemployment rate, unemployment, from our standpoint at least, has nowhere to go but up. So it's conceivable and reasonable to expect that you're going to see consumer credit losses go up throughout 2024. But again, I would call that normalizing rather than anything meaningfully worrisome from a consumer perspective. And I would say the same on the commercial side. Loans, we've had very low losses for 3 to 4 years, really, since the pandemic. And I think it's really reasonable to assume that losses have to go up. But again, in the context of what's normal, that should be expected.
You know, you mentioned on the commercial side, and it seems as if commercial real estate is kind of the three-word bear case on a lot of these, even without getting into the details. I noted, Goldman Sachs' results, they've really written down their office exposure dramatically. Feels like it's at a reasonable level. Have these banks, to some degree, outrun that issue, or is it manageable for most of them at this point?
Yeah, so I do think it's manageable. I think a couple things to keep in mind, and many of your guests have talked about CRE. These assets are clearly going to have some challenges. There are going to be some markets in B and C office that struggle. But it's important to note that these take time to work through, and banks really benefit from time, the ability to generate pre-provision earnings to pay for those credit losses over time. The other thing I would say, and this has been largely, I think, underreported, is banks, by and large, have taken significant pain and significant reserves for CRE office already. Companies like Wells and PNC, for example, have put aside 8.5% to 9% reserves against CRE office. That is a very high reserve. And from our perspective, many banks are probably over-reserved, at least in the kind of the large regional, the money center area. So to your point, we think a lot of that has been dealt with from an earnings perspective. And now it's more of managing that headline risk as things start to deteriorate.
And then quickly, you mentioned if we had a couple of more days like this, you'd be more aggressive in terms of doing some buying. Where in particular, what are a couple of your favorite names at this point?
Yeah, in the regional group, Truist, which reported this morning, would be our favorite. We think Truist is a very compelling risk reward. We think about banks simply on a risk reward basis, and it's a great banking franchise in the Southeast. It's a combination of BB&T and SunTrust. That merger has had some challenges in the near term, but we think that expectations are very low. Truist also has a significant insurance franchise that is about 15% of earnings, which we think will be monetized at some point this year. If you were to assume a monetization of the insurance business, the stub or residual bank is trading at just 7 times earnings. So we think Truist, from our standpoint, is a great opportunity. We would also point to Comerica, Fifth Third, Huntington, and Citizens.
All right, going to hear from Comerica, I believe, in the morning. David, appreciate the time today. Thank you.